welcome students. So we were talking in the last part of discussion about the preparation of the financial statements. So I was telling you that we have the trial balance here. So we are having the total of debit balances, total of credit balances, and both the sides are same. So here, and as I told you that all the assets and expenses have the debit balance and all the liabilities and incomes have the credit balance. So you see that all premises asset having a debit balance, plant and machinery having a debit balance, inventory is the asset having a debit balance. So all the asset, salaries are expenses having a debit balance, general expenses are expenses having a debit balance, and then we have preliminary expenses having a debit balance, and then we have the look at the liability. Share capital is a liability, credit balance, secured loan is a liability, credit balance, then it is the bills payable is a liability, credit balance, creditor is a liability, credit balance. So it's a set rule, always be clear about it, that all the assets and expenses will always have a debit balance. If you, for example, preparing the say ledger accounts and balancing it, or maybe you are preparing the trial balance and you are putting the different balances on the different sides, and if you find sometimes that it is an asset and having a credit balance, you always assume it, or you should be sure that there is something wrong in it, or some liability has having a debit balance in the trial balance, it is coming on the debit balance side of the trial balance, you assume or be sure that there is something wrong in it, because liabilities cannot have a debit balance, asset cannot have a credit balance, expense can never have a credit balance, and income cannot have a debit balance. So these are the some basic rules we should be clear about it. So total of this Mamta Fashions balances is you can say that is 41,96,175, 41,96,175, this is the total. And then we have some additional information which is quite interesting. Now you see that we have the additional information here, share capital. So you see, I told you in my previous discussion that we have the information about the authorized share capital and then the issued share capital. So this is the authorized share capital, which is company is authorized to at the time of registration, company is authorized that during its foreseeable life the company can issue how much equity shares, 1 lakh equity shares of 10 rupees each. It means total share capital the company can raise from the market by selling the shares to the general public to the extent of 10 lakhs. Similarly, 1000 preference shares at the rate of 100. So the preference capital can be raised to the tune of 1 lakh. So total 11 lakhs of the capital can be raised by this company by selling the shares in the market. Now we talk about the issued share capital. Out of 1 lakh authorized shares, company has issued the 30,000 shares of 10 rupees each. It means 3 lakhs of the capital has been issued by the company, and they have also got it because it is issued and this is they have received it. And 1000 preference shares have been sold in the market at rupees 100 per share. So again 1 lakh preference share capital is fully exhausted, and equity share capital is exhausted to the extent of 30%, and still 70% of the capital is there. Company wants later on at some later date they can issue 70,000 more shares in the market and to raise 7 more lakhs from the market by selling the shares to the general public. So equity capital is exhausted to the extent of 30% and preference capital is exhausted to the full extent. Now after this, if this equity capital is also fully exhausted, all the 1 lakh shares are issued in the market, and say all the 1000 preference shares are issued in the market. After that still the company needs, then they have to go to the registrar of companies. They have to request the registrar of companies to revise this authorized capital. They have to get it authorized, they have to get it revised, and this authorized capital has to be increased from the 1 lakh equity shares to maybe 2 lakh or 3 lakh equity shares depending upon the requirements of the company. Similarly, if they want to increase the reissue the say further issue the preference capital also, they will have to go to the registrar of companies and request that our limit for issuing the preference shares should also be raised. And after that we have some items like common depreciation is the one item which we have already dealt with. How to deal with it, that is clear. We have one item here that is a preliminary expenses, 20% preliminary expenses. I would like to share with you that what are the preliminary expenses and how to adjust them. Preliminary expenses are those expenses which are incurred before the company comes into existence. Say, as I told you that memorandum of association is required, article of association is required, when the company goes public, prospectus is required, then so many other kind of the official work, clerical work, and then other things are required to be done. Project report has to be prepared for certain projects. So there are so many preliminary expenses which have to be incurred by the company before it comes into existence. Now, at that time only these are expenses and no incomes, because company has not yet started the production. So when the company has not yet started the production and there is no as such incomes to the company, so these expenses are recorded and kept reserved. And when the company starts its business and the revenue start coming in, and when the company prepares its profit and loss account and balance sheet, then what happens? If these expenses are small, then they are debited in the first year's profit and loss account and they are recovered from the profit and loss account, it means from the revenue of the sales, and then that amount which is spent earlier in the market, that is recovered. But if it is a big amount, then in that case it is not justified to recover it from the first year's profit and loss account, because in that case the loss will go down seriously. So in this case the loss can be reduced and then these preliminary expenses are capitalized, means we show these expenses in the as total expenses. Say for example total expenses are 2 lakhs, so we will show these 2 lakhs expenses of preliminary expenses 2 lakhs as an asset in the balance sheet. These are treated like the prepaid expenses, as we have been treating the prepaid expenses, so they are treated as a prepaid expenses. Total amount of the prepaid expenses is shown as a asset in the balance sheet, and in the first year what percentage of these expenses is to be written off, that is brought and debited in the profit and loss account. For example, the total expenses are 2 lakhs. So when we will prepare the balance sheet, we will be showing it, we will take it to the balance sheet and we will show in the beginning balance sheet, that is the preliminary expenses, and here it is 2 lakhs, that amount is shown here, and we have decided that these expenses will be written off at the rate of 10% per annum. So it means out of this, when you are preparing the profit and loss account, then 10% of 2 lakhs will be 2 preliminary expenses, they will be provided here and will be debited in the profit and loss account. So it is 20,000 amount will be debited here, and if the 20,000 amount is debited here, so how much it is left here? Less written off 20,000. So the balance left here is 1,80,000 rupees. So this way we, after maybe say 10 years, this amount will become 0 and we have recovered the total amount through profit and loss account. So same way as we provide for depreciation, then we say that this preliminary expense is an asset, and that part of the asset which is used in 1 year, that is reduced. So it is like the process of depreciation, we recover the this preliminary expenses, and this process of providing depreciation and then writing it off or recovering the preliminary expenses through profit and loss account is called as the process of amortization. This is called as the process of amortization. So through the process of amortization, these preliminary expenses are recovered, and first they are capitalized, shown in the balance sheet as a total amount, and then every year a certain percentage is taken to the profit and loss account, and then we try to recover these expenses. So this is the way how we deal with the preliminary expenses. Then is the interest on term loans, we have already taken care of. Bill receivables are known to us, doubtful debts are to be provided. Here one thing is given to us, bill receivables rupees 25,000 were dishonored. What is the meaning of dishonored? Dishonored means that, as I told you in the last part of discussion, that say when any goods are purchased on credit, by one party from the other party or by one company from the other company. Then the seller supplies the goods and at the same time they write a will and present it before the buyer and buyer accepts it. So it means it becomes a legal document, proof that yes, buyer has bought the goods, supplier has sold the goods and buyer has to pay to the supplier at the later date. But when that later date comes and buyer for example refuses to make the payment, maybe because of one or the other pretext, he says that I do not have the money, he says that I will not pay, he says that your goods were defective so why should I pay, any kind of excuses he can take. So if he takes any kind of excuse, in that case that bill when it is sent to him that look it is you have purchased these goods from us, this payment is due, now you make the payment, but when he refuses to make the payment and he returns the bill back to the supplier or selling company, then that bill is considered as dishonored. So how to treat that in the accounting books, that we will be also discussing. Doubtful debts we have already done, inventory is the closing stock that we have done, income tax almost we have done, we will do it again, and now we will deal with the problem of dividend, that is dividend on the preference shares and on the equity shares we have to provide for, and then we will have to create some general reserve also. So what is required to be done? We have to prepare the profit and loss account for the year ending on 31st March 2016, profit and loss appropriation account also on the same date, and the balance sheet on the same date we have to prepare. So we are learning how to prepare the profit and loss appropriation account also, that is the additional new account we will be learning how to prepare it. Now let us start preparing the financial statements of Mamta fashion, and we will start with the trading account, which is very simple, nothing new, and as we have been doing in the past, same way we will be doing here also. So this is the trading account of Mamta fashion, and then trading, and then we will be going further with the profit and loss account, and then we will be profit and loss appropriation account, and then we will be preparing the balance sheet. So let us start from here, that is the profit and loss account of Mamta fashion. This is trading and profit and loss account of Mamta Fashion Limited for the year ending on 31st March 2016. 31st March 2016. So it is again particulars, this is amount, this is particulars and amount, this is debit and this is the credit balance. So let us start searching for the items to be taken to the trading account. First we are starting with the opening inventory. So it is 2 opening inventory, and the opening inventory here is 1,12,000 and 500s, 1,12,000 and 500s. We will not take debtors, land, cash, bills, receivables. Yes, we will take purchases, 2 purchases. So it is 27 lakhs. 27 lakhs is the purchases amount. Then we have preliminary expenses, no, wages, 2 wages. So wages amount is 7,500s, and then we have to look for the any other direct expense if it is there. So general expenses no, salaries no, bad debts no, interest on term loans no, equity share capital no, 10% preference share capital no, secured loans no. It means there is nothing now left here. So let us check for the, we will go to the credit side now. Buy sales, buy sales. So this amount is 31 lakh 20 thousands, and then we will have to go for the closing stock, that is buy closing stock. And if you look for the closing stock, it is given somewhere here, that is the value of inventory on 31st March 2016 is somewhere, it is 1 lakh and 35 thousands, 1 lakh and 35 thousands. So this is the value of inventory. Or there is any adjustment? First is share capital, depreciation, preliminary expenses, interest, bills receivables, doubtful debts, value of inventory, income tax, nothing is there. So now I think we can easily calculate the amount of gross profit or loss. So it is 0, 0, 0, 5, 5, then it is 2, and it is 32 lakh 55 thousands. And now we will have to calculate the gross profit. 2 gross profit, and when we calculate the gross profit here, the gross profit figure is going to be, let us calculate here, this is 1 lakh 12,000 and 527 lakhs. So it is going to be 28 lakhs 12,500, and then it is going to be 7,500. So it is 0, 0, then it is 0, 1, 0, 1, 2, and 28 lakh and 20 thousands. So we have total amount of this 32 lakh 55 thousands. So it is 28 lakh and 20 thousands. So it is 0, 0, 0, 5, it is 3, and then it is 4 lakh 35 thousands. So the amount of your gross profit is 4 lakh and 35 thousands. So 2 GP is 4 lakh and 35 thousands, and both the sides are equal now, 32 lakhs and 55 thousands, and both the sides are same, both the sides are equal. So we can total it up again, 0, then it is again 0, then it is 5, 5, 10, 1, then it is 3, then it is 7, 10, and it is 5, 15, 1, and it is 3, and then the total amount. So it is 32 lakh 55 thousands, and the amount of the gross profit is 4 lakh 35 thousands. Amount of the gross profit is 4 lakh 35 thousands, which we have calculated. Now it will be brought down to the credit side by gross profit. So it is 4 lakh 35 thousands, and then it is the other, now expenses we will have to take. We will have to deal with the other expenses like the other direct expenses. Premises we will not be taking, plant and machinery no, opening inventory we have taken, debtors no, land no, cash in hand, current account, it's a bank balance, receivables, purchases we have done. So we will be taking now the preliminary expenses. First item will be, so you will start from this only, and you can keep on ticking that which we have taken, that will not take it again. So it is 2 preliminary expenses, and that amount is 7,500. Then we will be taking the other items, preliminary expenses 7,500, wages we have already taken, general expenses we have, and now we have to take the general expenses, that is 2 general expense. So when we take the general expenses here, 10,252, 10,252 is the general expense. Is there any adjustment with regard to the general expenses? There is no adjustment with regard to the general expenses, we have taken it. Similarly, now we will be taking the salaries, 2 salaries. So we will be taking the salaries, and salaries are 90,338. Is there any adjustment here if we talk about the salaries? Depreciation, preliminary expenses, interest on term loan, bill receivable, doubtful debts, value of inventory, income tax, No, there is no adjustment with regard to salaries. We have already adjusted all the salaries here. It is 90,338. 90,338 are the salaries. Then we will be talking about the bad debts. Two bad debts. This amount is 31,065, but there are some, I think, adjustments for this. Let us check this adjustment. What is the adjustment here? We will be taking doubtful debts are to be provided 3,000. So it means we will be taking it separately, and there is nothing with regard to the bad debts. So it is 3165 can be taken directly to the outer column. 3165. This is 3165. Then we have others. Interest on term loans. Yes, this is important. To interest on term loans. To interest on term loans. So this interest which is already paid is 27,000. We will put it in the inner column. Why we are putting in the inner column? I would like to tell you that what is the total term loan. If you look at the figure of the total term loan, we will have to see here secured loan is this one, that is secured loan 12%, and this is 4,50,000. So we have taken the loan of 4,50,000, which means it is 12%. So the rate of interest is 12%. So what is 12% on the 4,50,000? If you calculate, then it is 54,000. Total amount of the interest works out to be 54,000. So it means if it is 54,000 and it is shown that the interest to the extent of 27,000 has been paid, it means there is a balance of interest to be paid. So it is add outstanding interest, and that is 27,000. So total interest figure will be 54,000. Total interest figure will be 54,000. So here it is the interest we have taken. Equity share capital no, preference share capital no, secured loans only interest had to be taken, so we have taken. Profit and loss account balance as on 1st April 2015. Now what is this balance? This balance is the opening balance of the profit and loss account, which is not yet added into the capital. It is kept as open in the revenue account, in the profit and loss account, and this will be added into this year's profit, and then the total may be added into the capital. It has not been added. We do not know the reasons why it has been kept as open, otherwise it should have been added in the share capital, but it has been kept as open. So this plus this year's profit, when we will prepare the profit and loss appropriation account, there we will be showing and we will be adding it up, and we will be transferring it to the, after paying the dividend, after creating certain specific reserves or general reserves, will be remaining amount will be transferred to the share capital in the balance sheet. So it is the done. So bills payable is a liability, creditors is a liability, sales we have taken, general reserve balance is also there. So when we will create a general reserve this year, we will add it up into the previous year's balance. So the total balance will be there in the profit and loss appropriation account, and finally that balance will be transferred to the balance sheet. Then we have the central sales tax payable. So we will have to take that tax also, which is central sales tax payable. So we will be taking that also, and the income tax part is different. So we will be taking the to central sales tax, to central sales tax. Central sales tax is 10,800. Central sales tax is 10,800. So almost we have taken all the expenses: premises, plant and machinery, opening inventory, debtors, land, cash on hand, bills receivable, purchases, preliminary expenses, wages, general expenses, salaries, bad debts, term loans, equity capital, then 10% preference capital, secured loans, bills payable, creditors, sales, general reserve will be taken later on, central sales tax we have taken. Now we talk about the, yes, we will be taking now the other items like your depreciation. So we will be taking the items like the depreciation. So we are continuing this account here, that is why I kept the space, and now I am extending it here. So it is to depreciation, and depreciation has to be provided on the depreciation to be provided at the rate of 10% on premises and 14% on the plant and machinery. So it is premises is 3,60,008. So it is 10% of this will be 36,080 is going to be the depreciation we are going to provide on it. The percentage given to us is 10% on the provided on the premises. So 10% of this is 36,080. So this is on the premises 36,080. Then we have 36,080 is on this, and then next item given to us was plant and machinery at the rate of 14%. So plant and machinery 14% is going to be provided. So it is say 4,95,000. It is at the rate of the percentage given to us is the 14%. So 14% is, this works out as 49,500 as 10%, and we will have to provide the 4% more on this. So 4% of this will be something like 0, 5 4s are 0, 22, 9, 4 9s are 36 and 38 3. This is 19,800 more. So this works out as 0, 0, then it is 3, 1, 19, 1, it is 69,000. So this depreciation will be on the plant and machinery is going to be plant and machinery, the depreciation is going to be 69,000 and 3,000. So there is no other item here. If we take this total depreciation, this is 0, 8, then it is 300, then it is 5, this is 1,05,380 is the depreciation amount. Preliminary expenses are to be written off 20%. So total preliminary expenses given to us were here, that is the amount is preliminary expenses amount is 7,500. Sorry, we have not to take the total preliminary expenses, we have to provide only for the 20%. So it means total is 75. So that will go to the balance sheet, and out of this we have to take the 20%. It means we have to only debit in the profit and loss account of this year is the 1,500s, and then we will have to take the other items like your depreciation we have taken, preliminary expenses we have taken, interest on loan, interest on term loan is to be provided for 6 months. So we have already taken the interest on loan for the 6 months, and then bill receivable, dishonor not to be taken here. Doubtful debts, yes, we will be taking one more item, 2 doubtful debts, 2 doubtful debts, and this amount is 3,000. So we will be taking the 3,000 as doubtful debts. Value of inventory we have already taken, income tax we will be taking later on, and other things. So I think there is nothing left now to be taken on the expense side of profit and loss account, and we have taken almost all the items, preliminary expenses, general expenses, salaries, bad debts, then interest on term loans, then it is general central sale tax, depreciation, and the doubtful debts. Now we will be talking about the credit side of the profit and loss account, where we will be recording the incomes, and then we will calculate the net profit before tax, we will provide for the tax, and then we will take the calculate the net profit after tax. So this all, and then after that we will be preparing the profit and loss appropriation account. This all we will be doing in the next part of discussion. Thank you very much.